Hey, Saretsky here. Welcome back to the show. Lots to touch on this week. Obviously, markets are in financial turmoil. There's a lot happening in financial markets. The volatility is off the charts. Stocks down. Bond yields blowing through the roof, which is typically the safe haven trade. Bond yields pushing higher, really showing that we are in a time of crisis. Now, I want to emphasize, I put out a video last week where I suggested to people that it was probably a prudent time to highly consider locking in your mortgage rate. Given the uncertainty in the world, given the geopolitical instability, the uncertainty around tariffs, that it was probably a good time not to mess around. Lock in your mortgage rate so you have comfort and stability in a very uncertain world that we're living in. And so hopefully you took that advice. If you didn't, unfortunately for you, we've seen unprecedented volatility in the bond market. Now, there is a metric that measures bond market volatility. It is called the MOVE Index. It touched a high of 172 this week, which is levels that we've only seen about 3 times in the past, call it 25 years. That was in every single time, 1998 long-term capital management, 2008 Lehman Brothers, and 2023 Silicon Valley Bank. So basically, anytime you've had sort of a financial crisis type of event, bond market volatility is blown out. That's the levels that we're at today. So something is seriously wrong in the system. Obviously, we know that Trump had to pause part of the tariffs for 90 days due to the bond market volatility. But ultimately, this gets home to the point of, listen, this volatility is here. It's probably here to stay in the near term. So you're going to see large movements in bond yields and vis-a-vis mortgage rates. So if you look at Canada's 5-year bond yield, which basically tracks 5-year mortgage rates in this country, those are up 40 basis points this week alone. 40 basis points is a very large move in a single week. So what you're going to see starting next week is most big banks are going to be raising their fixed rate mortgages. So again, if you're in the market today for a purchase, a renewal, a refinance, I would be hitting the phones aggressively this weekend and try to lock in some rates immediately, because again, you're going to see those rates move higher probably starting next week. Now, there's going to be a lot more volatility to come. So again, if you want certainty and your peace of mind, you should have locked in ideally last week. I still think that you're going to get an opportunity moving forward over the next, call it 3 to 12 months. You're going to get a window of opportunity, and it might be short, but I think you can get a window of opportunity to lock in once again, because ultimately I think we are entering a recession. There's simply too much global uncertainty. Businesses, companies, etc., people are very afraid to make investment decisions today. And this lack of investment decision making is ultimately going to be a huge drag on economic growth. And that should create a recession. And that should bring not only the Bank of Canada's rates lower, but that should bring your bond yields lower and your mortgage rates with it. But again, we are going to be in a world of volatility in the very near term. And so again, if you want that certainty with your mortgage payments, you should have locked in, but you will probably get another opportunity moving forward for those of you that are on variables and looking to convert them from variable to fixed rate, which you can do at basically any large bank in this country. So ultimately what we had here was bond yields blowing out in a time of economic uncertainty. The bond market is supposed to be the safe haven trade. It's supposed to be when in times of uncertainty and fears of recession, you're supposed to enter into the bond market. Bond yields are supposed to fall. Instead, they blew higher this past week, forcing Trump's hand to actually put a 90-day pause on tariffs. And this is a wake-up call. Hopefully this is a wake-up call for governments, not only in the United States, but in Canada as well, to get their fiscal deficits in order, their fiscal house in order. We know that Canada's budget deficits over the last 3 to 5 years under the Trudeau government have been enormous. Same thing here in BC, where I am. David Eby running massive record deficit spending, $9 billion this year. The only one that's going to put David Eby in his place and force him to fix the budget is going to be the bond market. The bond market is going to force David Eby's hand. We've seen multiple rating downgrades for BC's debt, and ironically, if you look at the BC revenue base, a lot of it has been predicated on a 20-year bull market in the housing space, housing and development, not just directly, but indirectly. Think about when you have lots of economic activity through housing, rising prices, it creates a wealth effect. There's additional spending off that. Every time you transact on a house, you go there, you buy furniture, you buy services, et cetera, et cetera, et cetera. So as the housing market bubble deflates, the golden goose of the BC government's tax revenue base is going to come under pressure. And this is something I've talked about at length of what's happening in the pre-construction market and why I say it's so important to continue to watch what is happening in the pre-sale market and the leading indicators of the housing construction market. So if you look at what's happening if you look at housing development as a whole, so you have to understand the housing cycle and how things are built. Multifamily projects take a lot of time and effort to facilitate. You have to go out there and acquire the land. You have to go through a multi-year rezoning process. And then you have to go and construct the building. So these can be 5 to 10 year processes. So once you have kind of started through that process of going out there to build a apartment building, let's say, once you've got the permit, you're basically forced to push through. You can't just sit on the dirt and wait because the interest costs alone will kill any economic viability of the project. So you have to push when you have it. And so there's this long lag cycle. So if you're looking for real-time metrics to say, okay, well, show me what is happening in the new construction space, you have to look at single family. So single family building permits in particular, because a single family is you can turn around a house. I mean, if you're quick, you can turn around a house here in Vancouver and call it 18 months. You can wait about 6 months for the permit and you can build the house in about 12 and you're done in 18 months. And so it's very easy when market conditions shift, it's very easy to turn the dial off. You just simply turn the dial off. And so if you look at single family building permits in BC, they are at all-time record lows. That's your leading indicator for what's coming down the pipe in the multifamily space. And we're seeing this in the pre-sale data with developers in Greater Vancouver here that are sitting on record levels of unsold inventory. The pre-sale market's dead, the assignment market is dead, and so projects that are already partway through the pipeline will have to continue, but you're really not launching new projects moving forward. And so again, you have to think about the economic drag moving forward. So I think this is a space that we're going to continue to watch. And one of the things that we've talked about is, again, because there's that lag cycle, is we still have a record number of units that are in the construction pipeline that are actively being built and that we're going to come onto the market over the next 6 months, 12 months, 18 months. And those are going to add to the overall inventory levels for sale. You look at markets like we talked about last week, the Fraser Valley, the suburban market where there was a lot of speculation and you had a lot of new home building. Condo inventory in the Fraser Valley is again at record highs, and you've got more inventory coming. And then we get the update from rentals.ca, which has been, I think, the leading supplier of rental data in this country, showing that rents in Vancouver down 5% on a year-over-year basis. Again, I would argue boots on the ground perspective is it's more like 10%. So you have to think about all these condos that are on the market that are not only facing a tough resale market, but you're seeing declining rents, which is putting more added pressure on sellers to sell. Because what we're seeing on a day-to-day basis with the calls that we get at our office is, hey, I've got this condo unit, I own it as an investment property, and I've been trying to rent it out at my old rent, which was whatever, $2,800 a month. I'm not getting any bites. I don't really want to drop the rent because I'm so used to getting $2,800. I don't want to lose out on any revenue. All of a sudden, I've got a unit that's sitting empty for 2 months. And that is, for a small investor, that's a lot. That's $5,000 or so in lost revenues. How long can you sit and wait? And so you're almost forced to make a decision. Do I hammer the rents down and live to fight another day, or do I go on to the resale market, try to sell this thing, take my money and leave? And again, that's why I think what we're seeing in the condo market in particular is more inventory that is building and building and building, because more investors are making the decision to exit the market. And this not only happens because of declining rents, but declining prospects of future growth. Future growth prospects are bleak. And so if you don't think you're going to have a great return over the next 3 to 5 years, many will just make the decision today to take their cash, liquidate, and move on to a different investment class. And I think that is exactly what's playing out in the market. So keep an eye on what's happening again in the permit market, keep an eye on what's happening in the bond market, and keep an eye on what's happening in the rental market. All of these factors are coming in and creating additional uncertainty. And I think it's going to teach many investors in the greater Vancouver market and in the greater Toronto market, you pick your poison, a very painful lesson, which is to say that we've had 10 to 20 years of unprecedented, unbelievable growth. And we've never really had any hard times. And only now, I think we are truly going through difficult times. And it's going to be difficult 2025 here. People that saw the market in 2022 thought that was difficult, waited until 2023. It's really been, I would argue, almost like a 3-year sort of bear market now. And it looks like that is going to persist throughout 2025. So again, those are some things we're keeping an eye on this week. Really watching the bond market, because I think it is showing us a lot here of governments that have run these massive deficits. And finally, the bond market is revolting. And in what is supposed to be a safe haven in a time of uncertainty, in a time of crisis, to see what is happening in the bond market, where bond yields are pushing higher, and it is no longer the safety trade, is going to have a lot of governments really rethinking things. And I think a lot of investors will have to do the same in the housing market as well. Again, I believe floating in this environment, while you will get one more opportunity, I think in the near future, floating in a world of economic uncertainty is not for the faint of heart. So that's my thoughts this week. As always, hope that helped, and we'll see you next week.